Okay, we are going to go ahead and get started. So this is tax strategies for passive investors. And again, like I said, I'm Megan Lamke with Goodegg Investments. So for those of you that don't know, Goodegg Investments, we've acquired over 7,000 units since 2017. And what that has accumulated to is over 9 million in value of all of those commercial assets, and our average annual returns on exits between 13 to 18%. We've been featured in Bigger Pockets, Her Money, Forbes, Yahoo Finance, Girlbox, and Market Watch. A little bit about me. Before joining the Goodegg team, I was a general partner and limited partner on over 3,000 units nationwide, valued at $585 million. And my background is in marketing automation. This is my family, and investing in commercial real estate, specifically real estate syndications, allowed me to really develop my passion in marketing automation and choose to work for great companies like Goodegg. So what we're going to do today is I'm going to hand it over to our other presenter, Marie Grasmier, who is the CPA on staff with Goodegg Investments, and she will be able to introduce herself and share all of the exciting tax benefits and advantages that we're going to go over today. So as I turn it over to Marie, you might be wondering, hey, I'm curious about the tax advantages, or I had this huge windfall in a business that I sold, or I sold a bunch of real estate, and you want to know some of your options. So we're really going to dive into the specific tax advantages today. So I'll go ahead and hand things over to Marie.
Hi, everyone. Hi, Megan. Thank you so much for inviting me today. I'm very excited to be here. We're going to be talking about taxes, fun stuff. And I really want this to be informational for you. I don't know how much experience you have, if you've been in syndications a long time, or if this is just you starting out. So I thought we were just briefly going to go through some very, very basics first. And Megan, are you going to up?
Yeah, I am sharing my screen of your presentation,
Okay.
just as I allow more people to join the room. So again, from a housekeeping perspective, if you could please mute yourself and leave your video off, that would be really helpful.
All right. There we go. All right, so taxes for real estate investors. Most of you are passive investors, and we're going to be talking about the difference between being a passive investor and an active real estate professionals. So let's see, do you want to move on? Okay, so we have a lot of different types of taxes, right? I think we just skipped over that slide. Okay, we go to entity election. I do an entire hour on just selecting the right entity for real estate investment. And the most common question I get is, if I set up an entity, how does that change the amount of deductions that I can take for tax purposes? And the answer to that is it doesn't really change the allowable deductions, because whether you invest in your personal name with your social, if you have a single member LLC, or if you have a multi-member LLC or a corporation, the tax deductions are the same. Any and all business related expenses with certain limitations you can deduct against the earnings. C corporations we generally avoid because of double taxation. When you take equity distributions in the form of dividend and profit distributions in the form of dividends, they're taxable to the owner again. So you do have double taxation. And in states that don't have income tax for individuals, you typically have income tax for C corporations. So you have federal and state in addition to the other type of double taxation. My foreign investors like the C corporation sometimes because you can avoid filing an individual income tax return in the US. S corporations generally we don't recommend using for real estate investments because of various reasons. Number one being the owner, shareholder of the S corporation should pay himself a salary on W-2. We necessarily don't want to deal with payroll. Single member LLC is taxed just like a sole proprietor, goes on Schedule C of your 1040. It's very simple. Generally, that's the best way to start out. If you have more than one member of an LLC, it's taxed as a partnership under the general rules. And most syndications are actually, it themselves are taxed as partnerships and pass-through entities. And we're going to talk more about that later. And joint ventures are pretty much the same. They're just less formal than a formal partnership or a multi-member LLC. Okay, so let's move on. If you do set up a separate entity, that entity should get its own tax ID number, an employer identification number. It's easily done. You can do it online. You get the number the same day. One of the benefits of setting up an entity apart from yourself is asset protection. And to get the benefit of the asset protection, we do want to see personal assets separate from the business assets. Business bank accounts separate from your personal bank account. So you don't want to commingle your personal assets with those of the business to maintain that integrity that's provided by the entity. Of course, also separate bookkeeping file. And when it comes to startup costs, so people say, well, you know, I've really been in real estate investment for like a year, but I didn't have my entity set up yet. I just set it up now in November. So what happens with all those costs that I incurred prior to setting up the LLC? Can I deduct them? And the answer is yes. So all those startup costs that you incurred prior to actually setting up the entity can be lumped together, and you can deduct up to $10,000 of those startup costs. And usually we see, you know, legal fees, research, maybe travel to look for properties, and professional fees being, you know, part of those startup costs. And I think we're going backwards here. Okay, so let's talk about syndications. Great way to invest in real estate. Generally, the syndication is a limited liability.
He's full of them. No. He's full of them.
Whatever.
I don't know if you can you hear me?
Yep, we can hear you, Marie. Sorry about that. There was just
okay,
a bunch of
I was muted, so I didn't know. Okay.
That had unmuted themselves. So again, just a friendly reminder, please keep your video off and yourself muted. Thank you.
Okay, so most often syndications are limited liability companies taxed as partnership. And the syndicator will be the general partner and the investors will be limited partners. And the syndication itself is not taxed. It's a pass-through entity. So it means that the items of income and expenses, gains and losses that occur at the syndication level will be passed on to the members on Schedule K1. So there will be separately stated items on the K1 that each partner, member, owner will be liable for tax on. And I think one of the questions I get a lot is, what's the difference between the items that are reported on my K1 and my cash distributions? Well, the cash distributions that you receive is your return on your investment, and profit sharing is not subject to tax to the extent of your tax basis in the syndication. So what does that mean? Well, the tax basis is basically your initial investment into the syndication, plus any current year contributions, plus current year pass-through income from the syndication, minus current year losses and expenses from the syndication, minus any cash contributions in the current year. So that means that that tax basis is going to go up and down every year based on those items that I just talked about. And when you get a cash distribution, as long as you have a positive tax basis, those distributions are tax-free. If you get excess distributions, then those are taxed as a dividend. It doesn't happen often, and most often it happens at the end when the syndication is, dissolving. So that is the main considerations about K1s, I would say, that you're taxed on what's listed separate on the K1 and not what you are receiving as a cash distribution. And syndications can also have separate allocations. So for example, in the operating agreement, they can allocate certain items differently to different partners. So they don't have to be pro rata according to your equity ownership. So if one partner really needs depreciation expense, we can allocate more depreciation to one partner. Maybe one partner has a lot of long-term capital losses on their personal side, so they want to be allocated more of capital gains to offset those loss carry forward. So there's a lot of flexibility that the syndicators have when it comes to allocation of different items. I think that's the main topics that I want to talk about when it comes to the K1s and syndications. So let's move on to rental real estate. Okay, so briefly we said that as a limited partner in a syndication, you're going to be a passive investment, and passive income and passive losses are different from earned income. So earned income is your W-2 income. Anything else that you receive on a 1099 NEC or a 1099, they used to be miscellaneous. Passive income would be interest, dividends, and rent. And generally, passive losses can only be offset by passive income. So there are two buckets. You cannot offset passive losses with your W-2 income, for example. There is a special allowance for rental losses. If your adjusted gross income for a married couple is 150 or less, you can take up to 25,000 of these passive losses. But if your adjusted gross income is higher, you cannot take any rental or passive losses against earned income, unless you are a real estate professional. It is a special designation that lets you deduct passive losses 100% against any other sources of income. And a lot of our real estate investors actually qualify for this designation, and it makes a big difference, especially if you have losses that are coming through on your K1 from a syndication. And there are two tests to meet to get this designation. And the first is that 51% of all your time and all your services that you do has to be in a real estate related activity with material participation. And in one calendar year, you also have to do more than 750 hours in a rental real estate trade or business. So what is a rental real estate trade or business? Well, there's no real, checklist for it, but we see, real estate property management. If you're an architect, then you design real property. If you're in construction, if you're a contractor, obviously if you're in real estate sales or you're a broker. So there's a whole bucket of different trades that would qualify for that, not only, being a syndicator, for example. So that's something you definitely need to speak to your CPA about. And that changes from year to year. So maybe one year you qualify, maybe the next year you don't. And again, it's a very gray area. So definitely speak to your CPA about that, because it can make a big, big difference when it comes to tax time. All right, so let's go to the next slide. Rental real estate management. And again, we're still talking about passive versus active. So for example, if you purchase a rental property in your own name, that activity will be reported on Schedule E as a passive activity. And if you have profits from that passive activity, it's not subject to self-employment tax. And self-employment tax is the equivalent of the employers and employees portion of Social Security and Medicare taxes. So the combined SE tax rate is 15.3%. So if you do have, a profit from rental real estate, you don't have to pay this 15.3% tax on it because it's not considered an active trade or business. On the flip side, you can have an active, Schedule C that is related to real estate. If you are a property manager and you actually actively manage your own rental properties and you don't have another job, then that could be a Schedule C that is subject to SC tax. And sometimes that's good, sometimes that's bad. You will get Social Security credits for any SC tax that you pay on Schedule C. You can also deduct a home office if you have a Schedule C. You cannot have a home office if you only have a Schedule E activity. And in 1 year, for example, if you don't have enough profit from your Schedule C to take fully advantage of all your home office expenses, you can carry forward those expenses to another year when you can take advantage of the deductions. So those are some of the considerations. And we've also lately been seeing that some of the Airbnb short-term rentals are reported on Schedule C as an active trade or business. All right, let's move on to the next slide. Depreciation. Okay, so we get a lot of questions about depreciation, right? What is it? What can we elect out of it? Do we have to take depreciation? How do we avoid depreciation recapture? So here we just have an outline of the general depreciation lives and methods. So commercial property, 39-year straight line. Most indications, get into commercial property or residential property, and we have 27.5-year straight line mid-month for residential property. And one of the questions that I got regarding recapture was, what if we don't claim depreciation? Can we just elect out of it and not take a yearly depreciation deduction? And at the end of the, at the end of the day, when we sell the property, there's nothing to recapture. And unfortunately, we cannot do that because the rules say allowed or allowable. So if depreciation was allowable, but you didn't take it, when you sell it, you have to act as if you took it regardless because it was allowable to you to take. So unfortunately, we cannot use that strategy. But what we can do to avoid recapture, which you actually have to report as ordinary income in the year of sale, and it will be on your K1, you can do 1031. So if you do 1031, you defer both the gain and the depreciation recapture. Obviously, you can sell at a loss. That's obviously not really what we want to do, but if you do sell at a loss, there's no recapture either. If you own a property in your own name, you can, your strategy can be to hold it until you pass away. And the person who inherits the property right now gets a step-up basis to the fair market value. So that's also a way to, to avoid the recapture. We also just have a few other tangible property, intangible property, qualified leasehold improvement property. And I think right now, the qualified leasehold improvement property, we have the ability to write that off 100% for a lot of syndications. So that's something that can really yield a good deduction. And we can talk about that more later. All right, let's go to the next one. So bonus depreciation. For a few years now, we've had 50% and 100% bonus depreciation on certain tangible properties. So when I say tangible, it's something you can physically pick up and bring out of the property. It's not attached to the structure. So that is, something that can accelerate depreciation that will, yield a tax advantage for you. You can elect out of the bonus if you don't want it. And you can also elect out of the makers, which is the modified accelerated cost recovery system. It's, when you use a double declining method. So you get a higher deduction in early years than the later, but there's an option to get out of that if you prefer a straight line. And I guess also to be cautioned about when you have properties in different states, some states will not allow the accelerated or the bonus depreciation. So you'll have a book tax difference sometimes. And then let's go to the next one. That's also related to depreciation, and it's the Section 179. This is the big one where we can elect to directly expense the cost of property that otherwise would have to be capitalized and depreciated. And right now for 2021, the limit is 1,050,000 up to 2.62 million in purchases. And this really benefits, manufacturers and people that invest heavily in machinery and equipment. And some of those qualified leasehold improvements fall into this category also, where we can write off those improvements. If you take this deduction, similar to what we talked about with the home office deduction, you cannot generate or increase a net operating loss, but anything that you don't use in the current year can be carried forward to next year. One of the big things that we talk about when it comes to year-end planning is the Section 179 deduction for vehicles and SUVs. We still have this in place, and basically any vehicle that has a gross loaded weight of 6,000 pounds or more and is on a truck chassis, we can deduct the entire cost of that vehicle against business income. And if you, for example, had that Schedule C we talked about, not only would that deduction offset your marginal income tax at that rate, but also the self-employment tax at an additional 15.3%. So you can really save a lot in taxes if you want to get into a big vehicle before the end of the year. And let's see what we have. Tax deferral strategies. So we talked a little bit about the 1031 like-kind exchange. You have to have similar property. So land or investment property, the usage has to be the same. And basically, when you go to closing, you cannot get any cash out. If you get cash, it's considered boot, and that's taxable as capital gain. But as long as all the proceeds go into escrow and is used for the replacement property, you can defer the gain, and the gain is just going to decrease your tax basis in the replacement property. There is some confusion about mortgage boot, and that basically says that, even though you used all the cash to put in the replacement property, you have to buy up. So from an equity standpoint, if you're relieved of debt, you must have equal debt in the replacement property as well. Otherwise, that's boot also and taxable as capital gain. So as long as you buy up from an equity standpoint in something more expensive, you can defer all that gain. And you can play that game, the 1031 game, as long as you want. There's no limits on the number of 1031s that you can do. The only thing is, at the end of the day, if you do this in your personal name, the last property is not going to have a tax basis at all. So the only way to get out of that is to, pass away, and then your heirs can get a higher tax basis. And I don't know that that's a really, really good strategy to use, but let's see. Opportunity zone. So I do in a whole other hour presentation on that. I don't think it's that popular anymore. There was a big hype about it when it first came out a few years ago, but that's basically a strategy where if you have long-term capital gains, you can put it into an opportunity fund that's located in an opportunity zone, specific designated area, low, that needs, economic improvement. And you can defer, 10-15% of the gain. And then at the end of year 10, if you still hold that investment, you get a complete step up in basis. So it's basically for people who have large unrealized capital gains that can be recognized, put into the fund, and sit there for 10 years. Tax credits and the opportunity zones can work together with all these other tax credits. I'm not going to go into those in detail right now, but be aware that they're there. And if you have questions, let me know. real estate investment trusts, also very popular, especially with my foreign investors. And there's two types, there's an equity and there's a mortgage type. So let's move on to the cost segregation study. So this is a very popular tool for syndications to use. So again, let's say you buy a commercial property, we have to write it off 39 years straight line. But wait a minute, this might be, an apartment complex or, hotel, and we have awnings and we have, build outs and we have, components inside of that building that if you turn it upside down and really shake it, it could potentially come out, and we can identify those assets and then we can write them off 100%. And that can generally create a big depreciation deduction. So we like to use it in a situation where, syndication just sold a property at a huge capital gain. Now in the same tax year, we go into a new investment, we do a cost seg study, and we can now offset the capital gain with the depreciation deduction. Okay, so yeah, I think that's it. As a general rule, it doesn't make sense to do it for anything under 1 million that I have seen, but that could be subject to change. All right, let's go to the next one. Yeah, so that's, again, this is a little bit more about the opportunity zone and the deferrals. It's a self-certification process. Any entity can become an opportunity fund as long as they are located, their property or their business is located in a designated opportunity zone. So this was a few years ago. Each governor identified, areas within their state that would be designated opportunity zones, and it's worked well for a lot. But there's a lot of tests to meet, and there's a lot of administrative, costs and time that goes into being and staying as a qualified opportunity fund, I would say. So let's go to the last slide here so we have time for a Q&A. This was just a few other strategies for real estate investors involving, life insurance. You can borrow against your policy, and for investments, use it like a checkbook, or you can just take the cash value, consider the cash value of your life insurance as collateral for a bank loan and use that to invest in real estate. Deferred plans, if you have income from self-employment, again, if you have that Schedule C, you can do SEP, you can do simple, you can do solo 401k. I know a lot of people are advocating for this EQRP, which is pretty much similar to a solo 401k. You do have to have earnings from self-employment. HSA, so health savings account. There's flexible spending accounts if you are, on a W-2. Charitable giving, especially before year end. If you're itemizing deductions, you can get a big benefit from that. Conservation easements, we haven't done a lot of those because it's a very highly audited area, but it does give you a big deduction if that's something you are looking for. Lifetime giving, charitable giving, planned giving, obviously things that you can implement throughout the tax year to reap benefits. So that's all I have for now. I know we went through that pretty quickly, but I wanted to have time for Q&A, so this can be, as informational for you as possible.
Perfect. Thank you so much, Marie. So if you have a question, go ahead and put it in the chat and we'll be sure to get to it. So if you have any of the questions, I know some have already poured in already. Yes, this is being recorded. Yes, we will make sure that it's sent to you after the fact. And one question that came in is, are we going to see a preview of a K1? No, I don't have one handy. Marie, do you have one handy?
Yes, I can get one really quick here. Yeah,
So again, if you have additional questions, go ahead and put them in the chat.
do you, let's see. I don't know if I can attach it in the chat or can I share my screen?
You should be able to share your screen.
Okay, I'm gonna share my screen. All right, can you see it?
Yes.
Okay, so this is just the top part. I'm gonna scroll down. So this is a sample Schedule K1 from a Form 1065, and the Form 1065 is your standard partnership return pass-through. You will have the year. It would let you know if it's a final year K1 or if it's an amended K1. If none of those boxes are checked, it's just a regular K1. If the entity has a fiscal year, not a calendar year, it will have the actual fiscal year beginning and ending in these boxes here. You will have the partnership's employer identification number. That's a tax ID number for the syndication. You'll have the name of the syndication address. You'll have the name, the IRS center where the actual partnership return, this one, was filed. And here is your information. So this is the name and tax ID number of the investor. We'll have an indication of what type of entity the investor is. If if you're general partner or if you're limited partner, if you're domestic or if you're foreign, if you're a disregarded entity, for example, a single member LLC, we'll have the tax ID number of that entity here that may be different from the tin up here. So let's say I set up an LLC. I am the only owner. Up here, it would show my social security number and my personal name. And then we'll have a checkbox here. And here in the tin will show the EIN, the employer identification number of my LLC, and the name of the LLC here. And so obviously you can invest in your deferred plan too. And if that's the case, you will have a box here. It will show the beginning and ending profit, loss, and capital. And the beautiful thing with partnerships, which is different from S corporations, is that even though, for example, my capital percentage is let's say 25%. I own 25% of the equity, but my profit and loss allocation does not have to correspond to the equity. It can be different. Partner share liabilities. So for example, this is where we have the information about financing. So non-recourse debt does not give me tax basis. It's basically debt that the syndication is liable for, and they cannot come back after any of the members or partners or owners for that debt. Qualified non-recourse financing. Okay, so recourse is obviously the opposite from recourse. They can come back. The general partner and the limited partner sign a guarantee on that note, and because I'm liable for that debt, I also get tax basis for it, which is good. So this is what we talked about. This is your tax basis, your capital account analysis. So first year you invest, you're gonna put in 500,000. It will be here. If that was the first year, you're probably not going to contribute anything more. But in a subsequent year, if there's a capital call and you invest more money, it will be on this line here. This will give you basis. Current year net income loss or current year decreases. That these two numbers here is going to come from what we see here, and we'll go through that later. And then current year distributions are going to be reported up here as well. And that, of course, decreases your basis. And then the sum of all these numbers here is your ending capital account. And this is your tax basis. And every year, this is going to go up and down. As long as the distributions that you get is not bigger than the number down here, those cash distributions are not taxable at all. All right, so this is just for basis purposes. If you contribute property with built-in gain, we don't really see that at all. Doesn't really apply, nor does that. So then every year in these boxes, you're gonna see numbers. And this is what you are going to include on your personal tax return, and this is subject to tax. So ordinary business income loss, most of you're gonna see a number in here, which is the net rental real estate income or loss. So that's like the gross rents minus all the rent expenses, including depreciation at the syndication level. And then, you know, this applies only to general partners, total guarantee payments. And of course, let's say syndication has a bank account that earn a little bit of interest income. That's going to flow through to you here. If they own an investment account, dividends are going to show here, royalties. And then when the syndication disposes of real property, it's going to be short-term or capital, long-term capital gain. Might be in here in these sections here.
So Marie, when a syndicator says, hey, for year one, we're going to have an on-paper loss on our K1, where does that show up?
I'm sorry, say it again. We're going to have a paper.
Yep. So a syndicator might say, hey, we're having an on-paper loss for year one because we did a cost segregation and there's bonus depreciation.
Right.
Where does that show up?
That's usually going to go in this box too.
Perfect. Okay. So another question, or did you want to keep going through the K1?
Oh, no, go ahead.
Okay. So another question that came up is, can you talk about how someone could invest in a syndication and then do a 1031 exchange in the form of a TIC into another syndication? So a tenants in common. So they originally invest in a syndication, it goes well, they're at the exit strategy of that particular business plan and they want to 1031 into a different syndication.
Yeah, that works just like a regular straightforward real estate 1031, because, you know, the syndication is like kind with the replacement syndication. So if there was capital gain on the disposition of the first syndication, then it just lowers your tax basis, this number here, in the replacement syndication.
Yep. The one important thing I know from my own personal history is that when you 1031 into a syndication, you need to be a tenant in common or have that TIC structure. Okay. So another question that came up is, can you at a really high level talk about the pros and cons of investing in real estate syndication that use either after tax dollars or deferred tax or tax-free funds, such as like if you use your 401k or your Roth, or if you're just using cash that you stacked up? Do you have high level pros and cons?
Yeah, I mean, the biggest difference is how you have access to the cash distributions. So if you are looking for cash flow, then you should not use your deferred plan, because just like your current 401k, unless you're at retirement age or you have hardship or a known exception from paying the 10% penalty, you're going to be taxed on the distribution and the penalty, unless you meet the qualifications if you invest in the 401k. So if you have a 401k and you want to take charge of what type of investments are in that deferred plan, then yeah, that's a great idea. But again, remember that any gains and distributions stay inside that plan until you start taking it out. And if you can't wait till you can take that out without the penalty, it's not a good investment.
Okay. And then another question that came up was, okay, let's say I'm a passive investor and I'm investing in syndications across multiple different states. Do I need to file multiple state income tax returns, or how do people go about mitigating this?
Yes, you may. The answer is yes and no. You may not. A lot of syndications that have multi-state activity will do a blanket composite return on behalf of their non-resident taxpayers. So let's say that let's say you do not live in a state that the LLC gives you, or the syndication gives you a K1 for. If they do a composite return, and if there's taxable income and they withhold that on behalf of the partners, you do not have to file a return because it's already taken care of on your behalf, you know. But if that's not the case and you get a K1, there you may have to file a state return as a non-resident in that state.
Okay, perfect. Again, any other questions, feel free to put them in the chat. Someone else asked about, could you go into more details on real estate tax credits? Is there a way that an investor can buy real estate tax credits, and if so, where?
Well, there are situations where you can work with an intermediary and merge entities and, you know, purchase entities, take over entities, so you can take advantage of other entities' tax credits. But the general answer is no. So the entity that generates a tax credit or is entitled to a tax credit is the entity that is going to be entitled to it for tax purposes.
Right. So the easiest way to get additional real estate tax credits is to participate in more real estate. So easy enough. Okay. So one thing that has come up is the difference between return of capital and return on capital when it comes to distributions. And so do you want to highlight a little bit about that?
I think that we may talk about the same thing. So let's say you invest in this syndication, and part of the deal is that on a monthly basis, you are going to get a cash distribution of a certain amount, right? Mm-hmm. So that's part of the deal. And it's a return of, you know, your investment and the return that comes out of current earnings and profits of the syndication. And they're not subject to tax as long as you have basis here in your ending capital account.
Yep. And then just that person asked another follow-up question. For Goodegg investments, yes, you do receive distributions either monthly or quarterly. It's not just on paper. The original question was, with K1s, because we do bonus depreciation and cost segregation on nearly every single one of our syndications, that generates an on-paper loss on the K1, and that's what Maria's been going through. Okay, perfect. So with that, if there's any other questions, feel free to go ahead and put them in the chat, or you can always email investorrelations@goodegginvestments.com. So again, that's investorrelations@goodegginvestments.com. And if you have more questions about real estate taxes, real estate syndications, additional great resources are the Goodegg Investment blog and our YouTube channel. But with that, I want to thank Marie so much for joining us today. Thank you for sharing your wealth of knowledge and just being here today.
Thank you so much for having me. I really appreciate it. And please feel free to contact me at any time.
Perfect. Will do. Thank you so much.
Thank you. Have a great day.
You too. Bye.
Bye.